How's it going, guys? My name is Eish, and welcome back to MoneyMetEish. If you're a member of the MoneyMetEish WhatsApp group, you would have seen that over the last few days, I've been pretty focused on Fundsmith, the UK-based equity fund with possibly the most creative name ever, run by Terry Smith. The fund was launched in 2010 and has since inception returned over 570%, a return which beats its benchmark, the MSCI World Index, by over 280 percentage points over the same time frame. This is not an advert for Fundsmith or their funds, although I did find out that their services are available to South Africans, but rather a look at what Terry Smith focuses on when looking for companies for the fund to invest in, and a short summary of a few points he made in his annual letter to investors. In his annual newsletter to investors, which I will link below, it's 12 pages of human English, not financiese. Give it a read. He outlines their very simple 3-step strategy for the fund, which is 1. Buy good companies, 2. Don't overpay, and 3. Do nothing. This is essentially what I want for MoneyMetEish as well, so this investor letter was really interesting to me. When we look at what a good company is, Terry doesn't really give an exact description in words, but from the letter and from a very helpful table, we can glean that a good company, by the fund's standards, is a company which has the following characteristics. High return on capital employed, or ROCE, which is a way to gauge how well a company is able to generate profits from its capital. A look at the table shows us that the ROCE of all of the companies the fund holds each year is 25% or higher, compared to 16% for the S&P 500 as a whole. The second characteristic is high gross and operating margins, with margins of at least 60% gross and 20% operating as opposed to 45 and 17% for the index. The average year of founding for the companies in the fund is 1926, meaning a large number of these companies are near or over 100 years old and would be very well established and some might say boring companies. The fund uses free cash flow yield as its valuation metric, a metric which I account for in the stock analysis spreadsheet, and DCF, which will be available to patrons who sign up for the MoneyMetEish Patreon coming soon. The fund is also quick to point out that the index has the benefit of including the companies that the fund owns, and so if they were removed from the index, the gulf between the fund and the index would be much wider. Obviously, this letter is a chance for the fund to brag about its performances and sell its services, so there's really nothing wrong there. Terry operates from a view that value is derived more from quality than just from a low price. A chart I found particularly interesting was this one. It shows the PE ratio that you could have bought each of these companies at in 1973 and still have beaten the market on a compound annual growth basis over the next 47 years, or between 1973 and 2019. You can see that even at a PE ratio well above market average, high-quality companies such as Coca-Cola and Altria, both of which we own, still provide you with above-market returns. Even with a PE over 200, which is approaching a level which most people would say is insane, companies like L'Oreal and Lindt, which are not particularly exciting in any way, are seemingly better companies than a lot of more sexy tech companies we see flying at really high expectations, especially since a lot of them are not even profitable. This is not the PE that the companies were trading at, but rather the PE that you could have bought at and still beaten the market. Avon, on the other hand, is garbage and wouldn't beat the market if it was given to you for free. I mean, not really, but close. The basic idea is that high-quality companies remain high quality and poor-quality companies remain poor quality. Or in Terry's own words, the biggest problem with an investment in low-quality businesses is that, on the whole, the return characteristics of businesses persist. Good sectors and businesses remain good, and poor return businesses also have persistently poor returns. A high return on capital employed alone isn't enough, though, and he also looks for companies with the ability to continue to grow this return on capital employed in the future. High-quality companies work not only to maintain, but also widen their competitive advantage, or moat as Warren Buffett calls it, while poor quality companies can easily be caught up to by competitors. They have little to no pricing power, or the lifetime of their products can be prolonged if needed. A car, for example. Terry ends off this section by stating that contrary to the mantra often spouted, past returns are actually a good indicator for future returns of a company. He even puts in this nice little chart to help make his point. There's also a breakdown of companies and their return on invested capital by sector, and I found it kind of interesting that a large portion, I'd say the majority, of JSE listed companies operate in sectors in the lower portion of this chart, with very few biotech, SaaS, or personal product companies available to the JSE investor on the local bourse, but a plethora of telecom, basic material, and retail stocks. It's just something I found interesting. Terry then goes on to give his thoughts on inflation, and what I took away from this part was, like we've said multiple times on the channel, if you own high-margin companies with a strong moat and pricing power, inflation is less of a worry, because either that increase will or can be passed on to consumers in the case of pricing power, or it can be absorbed by the company without losing too much of its overall profits to the company, as is the case with high-margin companies. This was just a short summary of a few points made by Terry in his letter. I would highly recommend that you read through it. I found it incredibly insightful and extremely interesting. I was made aware of Terry Smith and his fund by Joseph Carlson, one of my favorite finance YouTubers, who made a video about Terry Smith a few days ago. Thanks for watching, guys. If you liked this video, please hit the like button, share it far and wide, and subscribe to MoneyMetEish to be notified when we upload new content. Thanks, and have a great day.